Most people think they understand the silver market. They think silver comes out of the ground, gets sold, and shows up wherever demand exists. But what if I told you that the real problem in the silver market has almost nothing to do with mining at all? What if the real pressure point is something almost no one talks about, something hidden between the mine and the market? And once you see it, you will never look at silver supply the same way again. This is one of those quiet issues that doesn't make headlines, but it controls everything behind the scenes. And today, we're breaking it down clearly, calmly, and honestly, right here on Silver Reset. Before we go any further, if you care about understanding the silver market beyond surface-level headlines, take a second to like this video and subscribe to Silver Reset. It helps the channel reach more serious investors like you, and it tells the algorithm that this kind of deep, no-hype analysis matters. You don't want to miss what's coming next, because this conversation is bigger than price charts. Now let's slow this down and start with a simple truth. Not all silver is the same. This is where most investors get confused. When people hear that a country mined millions of ounces of silver, they assume that silver is immediately available to the market. But mined silver is not finished silver. It is not ready to be delivered. It is not ready to be traded in most professional markets. And it is definitely not ready to satisfy industrial demand. Between mining and delivery, there is a long, complex process that very few people understand, and that process is where the real bottleneck exists. Silver usually comes out of the ground mixed with other materials. It can be part of copper ore, lead ore, zinc ore, or gold deposits. That raw material then has to be transported, processed, separated, refined, tested, certified, and shaped into forms that the market actually accepts. Each one of those steps requires time, infrastructure, energy, skilled labor, and stable logistics. If even one of those steps slows down, the entire supply chain feels the pressure. Refining is not a simple operation. Silver refineries are highly specialized facilities. They cannot be built overnight, and they cannot instantly increase capacity just because prices rise. Refining capacity is limited, and much of it is already operating near its limits. Many refineries were built decades ago, during a time when industrial demand was very different from today. Back then, silver was mostly about jewelry, photography, and coins. Today, silver is deeply embedded in electronics, solar panels, medical devices, electric vehicles, and advanced technology. Demand has changed, but refining infrastructure has not kept up at the same pace. Now add energy costs into the equation. Refining silver is energy-intensive. Rising electricity prices, fuel costs, and environmental regulations have made refining more expensive and more complicated. Some refineries have reduced output not because they lack silver input, but because operating costs are too high. Others face regulatory pressure that limits expansion or forces shutdowns for upgrades. This is not speculation. This is how industrial systems actually behave under stress. Another issue that rarely gets discussed is geographic concentration. A large portion of global refining capacity is concentrated in specific regions. If trade routes are disrupted, if geopolitical tensions rise, or if regulations change, supply does not flow freely. Silver does not teleport from one country to another. It moves through ports, customs, shipping lanes, and logistics networks. Every delay adds friction, and friction adds scarcity where it matters most. And here is something most people completely overlook. Deliverable silver is not just refined silver. It must meet very specific standards. Bars must be the correct weight, purity, and form. They must be stamped, certified, and approved by recognized authorities to be accepted by major exchanges or industrial buyers. This process takes time, and it cannot be rushed without compromising quality or compliance. Even if there is plenty of silver somewhere in the world, that does not mean it is deliverable silver. This is why you sometimes see strange contradictions in the market. Headlines say there is enough silver globally, yet manufacturers report delays. Investors hear that supply is fine, yet premiums rise. Warehouses report inventory, yet delivery times stretch longer and longer. These are not accidents. They are symptoms of a system under strain in places that statistics do not capture. Delivery logistics themselves are another weak point. Moving refined silver from refineries to vaults, factories, or exchanges requires secure transportation, insurance, scheduling, and coordination. Any disruption, whether it's labor shortages, shipping congestion, or policy changes, can slow deliveries. Silver is heavy, valuable, and tightly regulated. You cannot simply move it like consumer goods. Now let's talk about the psychological side of the market, because this matters for investors. Markets tend to focus on what is visible. Mining output is easy to measure. It produces clean numbers. Refining capacity, processing delays, and delivery bottlenecks are harder to quantify. They don't fit neatly into charts, so they get ignored until stress becomes impossible to hide. This creates a dangerous lag in market perception. Prices often react late to structural problems because the data arrives slowly. By the time shortages become obvious, the system is already tight. This is why experienced investors pay attention to process, not just production. They ask where the system can break, not just how much is produced. Another important point is competition for refined silver. Industrial users often secure long-term contracts. They cannot risk supply interruptions. When refining capacity is tight, these users are often prioritized over smaller buyers or investors. This can create a situation where investment demand feels constrained, even when total silver production looks stable on paper. For individual investors, this means one thing. The silver market is not just about ounces. It's about timing, access, and form. Physical availability can tighten even without dramatic price moves. This is why understanding the refining and delivery chain gives you an edge. It allows you to interpret signals others miss. At Silver Reset, we focus on these deeper layers because they explain why the market behaves the way it does. This is not about panic or hype. It's about clarity. When you understand that refining and delivery are the true bottlenecks, you stop being surprised by delays, premiums, and sudden shifts in availability. As we move forward, these issues are unlikely to disappear. Industrial demand is growing, not shrinking. Energy systems are changing. Environmental standards are becoming stricter. Geopolitical uncertainty is increasing. None of these trends make refining easier or faster. In fact, they do the opposite. This doesn't mean silver is about to vanish. It means the system is less flexible than many assume. It means supply shocks can appear suddenly and resolve slowly. And it means that investors who only watch mining data are always one step behind. If this perspective is helpful to you, take a moment to reflect on how rarely this part of the market is discussed. And if you think more people need to understand this, share this video with someone who follows silver prices but may not understand the mechanics behind them. Also, drop a comment below and tell us what part of the silver supply chain you think is most misunderstood. Your comments help guide future discussions here on Silver Reset. As always, stay curious, stay grounded, and stay focused on understanding the system, not just the headlines. Thanks for watching, and we'll see you in the next video.